Hey everyone, me Kevin here. In this video, we're going to talk about what to avoid in the stock market, provide an inflation update, and we'll talk about the Federal Reserve as well as upcoming catalysts. This video is brought to us by FTX, which is linked down below, and you can learn more about them and sign up for free cryptocurrency when you sign up for FTX. Okay, so first, listen to some of these quotes here from the suits. Stocks have had an epically bad start to the year. Those are the suits now calling it epically bad. Blue chips are technically in a correction. That was on the front page of the Wall Street Journal today. Throughout the first 44 trading days of this year, the Dow and SPY have had their worst year ever. Their second worst year ever in 123 years. So second worst year ever out of 123. That makes this a pretty special year. You've got Better Mortgage, the company that was famous for having their CEO fire like 1,000 people on a Zoom call or multiple thousands of people on a Zoom call, just fired an additional 3,000 people. This is happening at the same time as banks and financials are just getting wrecked, which is ironic because a lot of people are like, oh, but banks and financials should be doing better during an interest rate hiking period, right? Not necessarily, because banks and financials really like transactions, and transactions go down in an interest rate hiking environment. It used to be that banks liked the interest rate. Don't get me wrong, they still do to some extent. But lower transactions, lower brokerage volumes, killing financials right now. And so maybe it's no surprise that credit card companies are starting to raise their fees for transactions. We'll talk about that towards the end of the video. And then when we look at some of the numbers that we've got out here, Brent crude right now at $128.78, the 10-year Treasury at 1.84%, up a little bit from yesterday, and the 10-2 spread now down under 25 basis points. We're at a spread of 23.88 for the 10-2. This is the lowest level that we have been in since the inversion of the yield curve in 2019. And remember, anytime we've had an inversion of the 10-2, we tend to have a recession within 18 months thereafter. Now, yesterday in my interview with Kevin O'Leary, he says, don't worry, it has to stay inverted for a while, but that part is up to debate to see how long it has to stay inverted. So we'll see. 5-year break even, which is a measure of the potential future expectations for inflation, just broke the highest level again. It has been going straight up day after freaking day, and you don't even want to look at this chart because it's gross. Look at this for a moment here. It is at 3.51. It's absolutely crazy. So the 5-year break even is crazy and inflation is going nuts, but we've got to talk about how to position for the stock market, what to avoid, and an inflation update as well as catalyst update towards the end of the video. So right now we know that cyclicals like financials, energy, materials, industrials, and consumer discretionaries are pricing in at their lowest levels relative to defensives, which are utilities, consumer staples, and real estate. We're at the lowest levels since November of 2020, which is worth noting. November of 2020, remember what happened right before November of 2020? In October of 2020, we had a lot of fear in the market. We had fear that getting a new president was going to lead the market to fall, that there was either going to be election uncertainty or that the results of the election would be uncertain. And so we had a lot of fear in the market. And anytime we get this fear in the market, we see a move over to things like utilities, consumer staples, and real estate. And we've even got a chart for this to kind of look at some of the difference here. So let's go ahead and pull up that chart just to see. This is the cyclical to defensive chart right here. And the more cyclical stocks become expensive, the lower this ratio is, right? The difference between the two here. So right now, anytime we see this line go down, it means defensive stocks are taking a little bit of a stronger positioning. And you can see that fall, obviously, over here. This was our, going mostly defensive time frame where we break under 100 in terms of a ratio. This is where people are more in defensives than they are in cyclicals, which again, cyclicals being like consumer discretionaries, which could be like your Etsy's or your Amazon, right? And real estate being on the other side, being a defensive, being more like investing in REITs. But anyway, now we're seeing that same or similar kind of fear, a level that we really haven't seen since about here, which was around that November of 2020 time. And we really took off when fear left the market. So I think the easy way to kind of conclude this sort of chart here is anytime you see the line go down, it means the market is getting more defensive. Every time you see the line go up, it means the market is taking on more risk. And so the last time we saw that sort of low point was around that election time frame when we had a lot of uncertainties in the market. And so you're seeing more people maybe crowd those defensive sectors right now. And one of the big takeaways of the video here that I want to talk about is stock crowding. Because stock crowding, in my opinion, is generally what you want to avoid. And so that could potentially mean that maybe there are opportunities to buy the dip on some of those uncrowded positions and stay away from the more crowded positions. And I'll show you a chart as to why. But first, what are some things that we know are really, really crowded right now? Well, in this particular chart, we just saw defensives are getting crowded. We also know that commodities are going to the moon. I mean, everybody's talking about how not only has nickel like 3x'd over the past year and a half, but that wheat's going to keep going to the moon, that oil's going to keep going to the moon. We're getting these outlandish bets that oil's going to go from $128 a barrel to $200 a barrel or $185 a barrel. And that's crowding a lot of folks into these energy stocks, especially like non-diversified ETFs like XLE, or people are following Oxy or Warren Buffett into Oxy, which Carl Icahn just sold out of, took $1 billion profit on it. So he's getting out, but Buffett and a lot of retail are flowing in. We saw yesterday $340 million of retail money go straight into energy. That was the biggest retail buying sector out of all retail buys yesterday. Yesterday, retail bought $1.5 billion worth of stocks. And so you're seeing a lot of money going into energy and commodities right now. And so they're becoming pretty crowded. And one of the big lessons that you always want to remember when it comes to the stock market is take a look at this chart. Okay, this is a critical one right here. It's this. Popular does not equal profitable. Anytime you get crowded stocks, you tend to see an underperformance. And that's literally what we've seen so far year to date. This is a year-to-date performance stock of retail sentiment indices. They threw ARK in here as the blue line, the crowded fund index, the hedge fund's most crowded stocks, all since December 31st. And what you can see is this massive underperformance of these crowded plays. So you see the S&P is the top line. That's down about 12% since December 31. You see the crowded fund index and the hedge fund most crowded trades. These are down to about 83 or 80, so basically down 17 to 20%. And then, of course, ARK's down there at about down 39%, along with the retail sentiment basket from Goldman Sachs down about 32%. So you really see that if you're in crowded trades, you tend to underperform. And so one of the warnings that I have for the market is that even though it's popular to get into those defensive stocks right now, to get into the XLEs, the energies, the wheat basket, and some of these defensives, one of the things to be cautious of is the more crowded the trades become, the harder they can fall. So be careful. It's kind of just like that meme momentum, right? The more we go up, the harder we can go down, and the faster we can go down. And so one of the things that I advocate for is setting those trailing stops. So if you're investing in these, set those trailing stops 4 or 5% on some of the more crowded trades, so that way in the event there's a U-turn, you're a little bit insulated. Now, the other thing that I wanted to talk about was inflation, and how obviously we're seeing a big move and a lot of fear that inflation is going to be a lot more long-lasting. And the worst-case scenario is that inflation ends up becoming anchored. Because when inflation expectations become anchored, then the Federal Reserve has to work to unanchor them. Right now, Jerome Powell is really proud because he says that they have done a very good job at keeping inflation anchored low. And that's because when we look at things like the University of Michigan consumer sentiment indices and inflation expectations, we see that consumers expect inflation to come down, like halve over the next year. As long as that stays low, the Fed might not have to Paul Volcker us. But we have these massive fears that we could end up in a situation where used car prices keep going up. They're up 40.5% over the last year. Used cars make up 5.5% of CPI. New cars are up 12.5% over the last year. They make up 4.5% of CPI. We know that rent makes up 9.6% of CPI, and housing in total makes up 39% of CPI, and this lags. So even if we see car prices come down a bit, if we just see rents move up the way they should because they use the stupid owner's equivalent rents and they super lag on CPI, well then we could end up seeing inflation really move up substantially over the next few months, especially as oil prices drive up inflation. Remember, if we hit $150 a barrel, we would expect CPI to be 2% higher solely because of higher input costs from oil, which is a lot. And so this does still create this downside risk for the Federal Reserve. And we've got the CPI report coming out in 2 days. But I just want to urge a caution that that CPI report isn't really going to give us the data that we need yet. Whether we get a miss on Thursday or we get a beat on Thursday doesn't really matter, because we want to know what inflation is, not from a snapshot from February, but from March and April and May. That's what we want to look at. Because remember how messed up it is in terms of how they measure inflation for volatile things like gas prices in CPI. What they'll do is they'll say, okay, here's our CPI for February, let's say. The expectation right now is that CPI is going to come in at 7.8%. And the month over month is expected to come in at 0.8% minus food and energy 0.5%. So write these things down. You should have these written down, by the way. These are the expectations. So 0.5 month over month without food and energy. So these are the expectations. This is annualized, 9.6%, which just means we multiply by 12, right? This annualized is 6%, again, multiplying by 12. So these are the expectations. But whether we get a miss here or not doesn't really matter, in my opinion, because why? Well, the energy shock isn't really going to be fully priced in into this February CPI report, because the way they'll look at February is they won't look at Feb 28th and say, okay, oil was, let's say, $100 per barrel. Let's include that in CPI via gas prices or whatever. What they'll actually do, because they're not looking at oil prices anyway, they're looking at gas prices, but gas prices follow oil prices. But anyway, what they'll actually do is they'll look at what were oil prices Feb 1 to Feb 10. Then they'll do the same thing for approximately Feb 11 to Feb 20, and then the same thing for Feb 20 to Feb 28. And then they'll take these three little baskets right here, and let's say oil prices were 90, 95, and 100. Well, then they'll just take the average and they'll say, okay, cool. Gas prices are essentially close to 95. Okay, sorry, one sec. There we go. Yeah, so that shows how CPI lags. CPI lagging is a problem because it means if we end up getting like an 8% read this time, let's say, when the expectation is, what did I say it was, 7.8%, we get an 8% read, fine, probably gonna end up being worse next month. So I actually think April, for the CPI release that we get in April, that's probably the one that's gonna create more heart palpitations than this CPI release. So I'm not hanging my hat much on the CPI release. I'm more concerned about that longer term, because if we don't see that inflection point down, there's still a massive risk that the Fed ends up U-turning ugly on us. Now, the easiest way, in my opinion, to understand how the Fed's kind of been playing us is to think about it like this. So let's say that going sort of down here is them supporting the economy and being like helpful to stocks, right? To being helpful to us, right? So the Fed's kind of been playing down the fears of inflation forever, calling inflation transitory. Well, in December, we got this really ugly shock where all of a sudden they're like, big U-turn. Oh crap, inflation's horrible. Inflation's no longer transitory. We have to taper faster. We have to taper more aggressively. This is terrible, right? Absolutely terrible for stocks. And this is why we saw that pain in December and January, especially when those minutes came out in January. Well, because of the crisis in Ukraine, we've kind of seen a little bit of a softening in the Fed's stance, but I don't want to say that they've turned super dovish. I think they've more gone onto pause here. And there's a real concern about them going into this pause mode because we're going to get this data here for Feb CPI. Then we're going to have the FOMC meeting on the 16th. So this is on the 10th. And then we're going to get the March CPI in April. March CPI, we'll just write April right here. And it's entirely possible that if we keep seeing inflation come in with these terrible reports, that the Fed will actually just sort of be like patient for the time being. We'll see these over and over again, 25 basis point hikes over and over and over and over again. But if CPI continues to come in high, it's still entirely possible that the Fed could end up having to Volcker us and they come in with some crazy interest rate increase where all of a sudden they come in with like a 100 basis point increase or a 75 basis or 50 basis point increase, and then they rug pull us. So this is still very much a reality or potential for 2022. And this is why the two big things that I want to really address in this video are, number one, be careful about those really crowded trades. But number two, we're not in the clear. Just because the CPI report on Thursday comes in at expectations or below or above, stand by. I don't think we're in this market where we want to be all in just yet. At the same time, you're still seeing companies raise prices. I mean, just today we saw Apple raise the price of the iPhone SE by 7.5%. Also, according to the Wall Street Journal, Visa and Mastercard are now raising their merchant fees. These are the fees that businesses have to pay. They don't really, they're sort of invisible to the consumer because we swipe our card, we don't really see it, but they're sort of the back end fees. And both of them, both Visa and Mastercard, are raising their fees. In 2021, just for example, merchants paid $55.4 billion in merchant fees and credit card fees. These fees, by the way, lead to like huge profit margins for Visa and MasterCard. There's a reason they bring like 40 to 50% to the bottom line. A lot of it has to do with these fees. And so apparently these fee increases will affect mostly online purchases, though it looks like really all fees are going to be increased, with the exception of some of those on lower businesses with Visa who have less than $250,000 in annual consumer credit card volume, which that's a really low number. I mean, if you're only selling $250 in goods, that's not a lot for any business. So that's like the micro businesses there are getting a little bit of support. But otherwise, those fees are going up. So all across the board, you're seeing companies, and of course, every earnings report that we've looked into, all across the board, you're still seeing price increases. Those have not all been reflected yet in CPI. So I think we have two massive warnings. And of course, shout out again to FTX before I recap those two. FTX is the awesome way for you to use trading views, technical indicators, at the same time as being able to trade cryptocurrencies. I have this up every single day on my computer, and you should as well. Check out FTX via the link down below. But the big takeaway here is twofolded. The number one big takeaway, in my opinion, is be careful about those crowded trades, the ones that seem really sexy, the one everybody's going into, you know, the palladium or the nickel or wheat and oil-related trades. And those are great for making quick money, momentum, meme style. But always remember to set yourself a stop loss so that way when and if that trade reverses, you've got some protection. I do think that buying commodities could be a hedge against maybe your, let's say, tech portfolio or portion of your portfolio, or maybe even the indices in general, because the more we see oil go up, for example, the more the SPY and NASDAQ seem to come underweight. So it's entirely possible that those could be a hedge. But again, just set your limits so that way you're not part of a big sort of cycle to the downside in these. I mean, there's a reason the CEO of Occidental Petroleum today mentioned that we're not planning on significantly increasing our production because we're just going to take the extra cash we're making now from more expensive oil and we're going to use it to pay our shareholders when the oil market comes down again. Like when the CEO of the oil companies are telling you this, it's because they know these prices don't last. They come up and then they fall. They come up and then they fall. It's all a game. So just remember that if you're making bets on these. And then another thing, obviously, to keep in mind is that Fed rug pull that we talked about. Be careful because there are a lot of things that could still lead them to rug pull us. There's also talk, and I thought this was sort of just an interesting little bonus note. One of the individuals who was interviewed on CNBC this morning, they mentioned that we might actually walk into what's being referred to as a sentiment recession, which is if the global economy starts getting too nervous about the outcome of potentially war with Russia certainly war with Russia and Ukraine, but also potentially war with the European Union nations or NATO, then there could be a, quote, sentiment recession where you see people purposefully start paring back their borrowing, which you're already seeing in China, and increase their savings. And then you get those negative comps where all of a sudden you actually start seeing negative year-over-year comps, and that's your start to a potential recession, which could be why that 10-2 yield curve is also falling. But best case scenario, we could get over these hiccups, these shorter term catalysts, inflation catalysts, Russia catalysts, and we just go back to the moon. But until some of these catalysts get cleared, I'm not super impatient in trying to time my entries, but I'm definitely entering when there are big fear days. So, but again, still not all in, certainly not YOLOing onto call options, more interested in selling calls, selling puts, and staying out of margin and debt. All right, that's that for that video. Thanks so much for watching. Make sure to check out FTX via the link down below, and we'll see you in the next one. Bye.